Hey, hello investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I show you how I use my portfolio in order to make weekly income. For today's video, it's going to be about maximizing your chances to win in the stock market. And if you're looking for a way to generate income and potentially buy stocks at a discount, this strategy is going to be your golden ticket. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. For today's option strategy, we're going to be going over the wheel option strategy. Now, this strategy combines selling a cash secured put and covered calls in order to generate income and acquire stocks at a discount. Now, this is a very repetitive step by step strategy aimed at long term income. However, you will be making short term gains. That's the beauty of using the wheel option strategy. Now, before you get started, you guys know how we like to get down and dirty with options, meaning we show you exactly what's being done to our portfolio in order for you to be able to follow along. And you could later go back and practice this using your own portfolio. But before we get into that, there's a couple things that we have to address. So stick around till the end because I'm going to be sharing some tips on minimizing the risk and how you can avoid the common pitfalls that many beginners fall into. And right before we get started, this is what you're going to need in order for you to perform the wheel option strategy. Number one is going to be a basic understanding of options basics, meaning you need to understand puts, calls, premiums, and also strike prices. You're going to need a brokerage account that allows you to trade options. And you also need to ensure you have enough cash to secure your options as well. And finally, you need cash to secure 100 shares of any of the target stocks we will be engaging in today, meaning that you're dealing with stocks in increments of 100 shares whenever using options. That being said, our stock for today, we're going to be using none other than one of my favorite stocks of all time, which is going to be Marathon Digital, ticker MARA. Okay, so here we are on Mara, and as usual, we're going to go ahead and open up the Mara option chain by hitting Trade Mara Options. So now we are on the Mara option chain. Now, it is common misconception whenever starting the wheel strategy that you need to start with a cash secured put. That is not correct. Feel free to start with the cash secured put or the covered call. It always depends on what the market gives you. If you take what the market gives you, you will be in the market a lot longer than most. Market is at hitting all-time highs right now, so we're going to go ahead and we're going to start with a cash secured put. So for the cash secured put, we must make sure it says sell and also put. Now, these option strategies are aimed at making sure you get premium as soon as you perform these option strategies. And that is why I love this option strategy. Now that we have sell and we have put, we're going to go ahead and we're going to choose our strike date, which Robinhood has already selected for us, which is going to be November 29th, which gives us about 6 days out. In order to maximize the efficiency of the cash secured put, it is highly advisable that you go ahead and you choose your strike price below the current share price. As you can see here, the current share price is trading at $26.41. So now we're going to go ahead, we're going to go down and we're going to choose our own strike price. Now, I'm going to be going with the strike price of $24. And with the $24 strike price, I'm going to be receiving $1.02. In option language, this translates to $102. Now, one thing to keep in mind, if you look up here, you're going to see your chance of profitability. Now, my chance of profitability for the cash secured put is at 71%. The majority of the time, I like choosing a chance of profitability at 18%. However, based on me trading this stock for years upon years and the amount of money I made on this stock, I have decided to go with a 7% chance of profitability because this stock I do not mind owning in my portfolio. So now we're going to go ahead, we're going to hit continue. And there we have it. As you can see here to the top, the cash secured put. Now, in order for me to do a cash secured put, I must have in my account enough cash to cover this option strategy. So let's go back to the option chain once again. So my strike price is going to be $24 per share, and I'm trying to acquire 100 shares, meaning I will need to have $2,400 in my cash portfolio in order to do this cash secured put. How do you come up with the $2,400? Well, that's quite simple. It's going to be $24 multiplied by 100 shares. Now, that is the cash secured put. So, how do you win and how do you not so win with the cash secured put? I'm not sure if I mentioned this earlier, but the cash secured put and the wheel strategy is what's known as a win-win option strategy. So, how do you win with the cash secured put? Well, with the cash secured put, come expiration date of November 29th, if Mara is trading at any price above this $24 price, then we get to keep our premium of $102. And then we get to do this strategy again the following week because now our $2,400 collateral will be released back to us. Now, the other way this option strategy could go is the not so win strategy. Once again, come November 29th, if Mara is trading at any price, $24 or below, then we're going to be assigned on this option strategy. And now we'll be forced to buy 100 shares of Mara at $24 per share. Once again, here's the best part about it. We get to keep our $102. And now we own 100 shares of Mara in our portfolio. Now, I will get back to this premium right here because this premium helps us in so many different ways. And that right there is the first part of the wheel option strategy, the cash secured put. If you're enjoying this video and you're getting any value from it, now would be the perfect time for you to go ahead, like the video, subscribe to the channel, and if you have any questions concerning the wheel option strategy, let me know in the comments below. Now, let's go to the second part of the wheel option strategy. Now, we will be assuming that you own 100 shares because you were assigned on your Mara sell put. So now what we're going to be doing what's called selling covered calls. You can only do covered calls if you already own 100 shares or more in your portfolio. It cannot be done if you do not own 100 shares. So let's go ahead. We're going to get out of here. Now, with the assumption that we own 100 shares of Mara in our portfolio, now we're going to switch up the strategy to covered calls. So for that, we're going to make sure it says sell and call once again. Now, once again, this option strategy involves us selling. So you will be receiving income once you do this strategy. And once again, that is the brilliance of this option strategy. You keep generating income over and over and over. Now that we have sell and we have call, we're going to go ahead and choose our expiration date. And once again, we're going to do it 1 week out. Now, I like to do options expiring 1 week out, and that is based on my own personal preference and risk tolerance. Feel free to choose whatever strike date works for you. Now, with the covered call option strategy, remember, this is the second part of the wheel strategy. Now we're going to go ahead and we're going to choose our strike price above the current share price. Now, once again, the share price is at $26.41. So we're going to go above that price and look for our new strike price. So let's go ahead. And now I'm going to be going with the $29 strike price, and that's going to pay me $1.10. Let's go ahead. We're going to click into that. Now, keep in mind, now I'm doing the covered calls. As you can see here, my chance of profitability, I increased it to almost 80% chance because that works for me based on my risk tolerance. So let's go over here. And as you can see to the top here, the covered call option strategy. We're going to go ahead, we're going to hit continue, and there you have it. So like I mentioned earlier, once you're doing the covered call strategy, you stand to gain income right away. That income is known as premium. And in this case, this is going to be $110 for us. Now, how do you win and how do you not so win with the covered call option strategies? So let's get into that right now. So with the covered call option strategy, from expiration date of November 29th, if Mara is trading at any price below this $29 strike price right here, then we get to keep our 100 shares. And most importantly, we get to keep our initial premium of $110. And now you could go ahead and sell an additional covered call for the next week until you're assigned on these options. Assigned is going to mean that you're forced to sell your 100 shares at whatever predetermined strike price that you chose. So again, if come expiration date of November 29th, if Mara is trading at any price above this $29 strike price right here, then you're going to be forced to sell your 100 shares at $29. So once that happens, now you could flip the strategy around again and go ahead and do cash secured put. And hence, we come full circle with the wheel option strategy. So feel free to start off with anyone, the cash secured put or covered call option strategy. Once you're signed on either of them, then you go ahead and you do the other strategy to just keep generating income for the long term while making short term benefits of options premium. Okay, so what are the benefits of the wheel option strategy? Well, for one, it will give you regular income because you're selling options. Once you're selling options, you're going to generate option premium and you're going to keep doing that over and over consistently. One of the other benefits for the wheel option strategy is the consistent cash flow it provides regardless of market direction. As long as the trades are managed properly, doesn't matter if the market is going up or the market is going down, you will continue to make premium. Another key benefit of the wheel option strategy is the opportunity to buy stocks below market price when assigned on cash secures put. And lastly, the cost basis is reduced due to collected premiums. Now, I did ask you to remember the options premium. Now, kicker. Whenever you receive option premium, what it does, it helps to reduce your overall cost basis. So let me give you a quick example. So this covered call now, if you are assigned, your cost basis is no longer going to be $29 per share that you need to sell your options. It's now going to be $28. How did I come up with that? Well, it's going to be $2,900 first of all, $29 multiplied by 100 shares. Secondly, you're going to subtract $100 of premium from your $2,900, and that's going to give you $2,800. Now, the $2,800 divided by your 100 shares, your cost basis is now reduced to $2,800. Now, every time you keep doing this, your cost basis keeps going lower and lower and lower. Here is the key benefit of lowering your cost basis. You're now able to sell covered calls at a way less strike price. And what that's going to do is going to give you way higher premiums. Again, the wheel option strategy is a win-win option strategy. Now, it would be remiss of me not to mention the risk involved in the wheel option strategy. Not everything that's shiny is gold. So, here's how you try your best to mitigate your risk. Do not get caught up in being assigned on a stock that's falling rapidly in the market. What that means, let's use Mara since we already have it open. If you are assigned on Mara and a cash secured put, using the example from previous, at let's say $28, and the next week it falls to $26. The prior week it falls to $25. That is a falling stock market. You need to get out of the stock. Do not get emotionally attached to any stock. The other way you can mitigate risk when using the wheel option strategy is to make sure you choose stocks you're comfortable holding on to long term. There are a risk of assignment, meaning that you will be forced to buy 100 shares of the stock. So, why not be forced to buy 100 shares of a stock that you already want to own in your portfolio? It makes complete sense, right? Another thing you need to look out for is the stock volatility. Now, my personal preference, once again, I absolutely love the stock volatility. The reason why I love the stock volatility is because I am guaranteed to be paid higher premiums. The downside of the stock volatility is that if the stock is volatile, you may face unexpected assignments or struggle to sell your covered calls at an instant. Stick to stable or dividend paying stocks with very strong fundamentals. That's going to help mitigate your risk even further. So, what happens if you fall in love with the stock and you don't want to get assigned? Well, number one, don't fall in love with the stock. But if you absolutely do fall in love with the stock, there are some stuff you can do. Consider this. Consider rolling out your options. Now, rolling options is an excellent way in order for you to continue generate additional premium and help you safeguard the stock if you want to continue holding the stock in your portfolio. Now, I do have videos on rolling options. I will try to link it above. So, how do you almost guarantee success when using the wheel option strategy? Well, here are a few tips that you could use. Avoid stocks with poor fundamentals, even if the premiums are very, very attractive. Always try to get with companies with steady growth, solid dividends, and a strong market position. Now, I like to use Mara because Mara is extremely volatile. This may not be a very good stock in order for you to start off with. So remember, always use your own due diligence before investing. Consider the state of the market and the specific stock trend. Remember, I did mention this at the start of the video. Try to use whatever the market gives you. Now, choose strike prices that balance with your risk and reward. Premiums should be high enough to justify your potential obligation without excessive risk. Again, this is all based on your own due diligence. Now, if you made it this far in this video, it means you're considering doing the wheel option strategy. That being said, the wheel option strategy is here to help you, and so am I. Remember, do your own due diligence before investing and subscribe to the channel for more. Hit the like button, but most importantly, if there's anyone out there that can benefit from this video, feel free to share it with them. And until the next video, keep pushing your investments.